Foreign exchange market, or FX as it's known. This is interesting because this is actually the market that I started out in when I first got into trading. And I used to work for a very large bank basically, and we used to trade foreign exchange on behalf of large clients, and also the bank used to have its own position, so we used to make money from trading our own market. It's a 24-hour market. There's no actual trading floor. It's basically on computers. It rolls from Tokyo to London to New York. It's one of the biggest markets in the world, and it's very, very liquid. What do I mean by that? There's always buyers and sellers. The only times the FX market is closed is basically the weekends. But as I say, it's a huge market. Good news is you can also trade the FX market. You can start, with small accounts. In the old days, you'd need like at least 100,000. Now, £250 account, and you can trade FX markets. Also fixed odds. You can trade with like little as £10 a bet. So what's trading currencies all about? Well, you've probably traded currencies when you've gone on holiday. You've gone to the Bureau d'Exchange and you've wanted to buy some euros or Swiss francs or dollars. Well, obviously here we're not talking about notes. We're talking about trading the currencies, but obviously in an electronic form. So we're never going to take delivery. When you're looking to buy a currency, say the euro, you basically want, you'd rather have 160 to the pound than 110. So you're buying high. When you come back with your unspent euros, you basically want to change them back to pounds, and you're looking to sell low. So as I said, no notes basically change hands. Everything we're going to do is electronic. You're only trading on relatively small percentage changes. The markets that we tend to trade are forward currencies. Why? Because we don't really want to be in currencies that are just day trading or getting in and out every day, and we can also use fixed odds bets. So here you can see the IG index screen again. Currencies, near quarter, major FX. Okay, and these are the markets. Now, most currencies, when you just say the pound or the euro, most people are talking about the US dollar. Okay, that tends to still be the main currency that you tend to benchmark against. But of course, there's pairs of all sorts. But on the whole, the majors, it still tends to be the currency against the dollar. If you don't know the codes, you can look them up, but you'll soon learn them. The first one here is the CAD, is the Canadian dollar against the US dollar. The next column here is the contract. It's a June contract, and again I explain contracts in the workbook. Every bet has to have an expiry date. Doesn't mean we have to wait until that expiry date, but there has to be a contract and expiry date. We can also roll over and go into a new bet. This is the price that we sell, this is the price that we buy. If we think the Canadian dollar is going to weaken against the US dollar, we sell it. If we think it's basically going to strengthen, we buy it. And that's the change today, 11 points. We've got the euro against the yen, and a number of currencies. But as I say, I cover currencies in the workbook. This is what they call the minor FX, but again, these are still large currencies. This is the Australasian, maybe Australian New Zealand dollar. These are the Scandinavian currencies. And then the major currencies that you're going to trade. Now, there's two ways to trade, whether you're trading currencies or whether you're trading the stock market. It tends to be fundamentals. Fundamentals is basically news, such like wars, stability of a country, interest rates, unemployment news. Problem with this type of data is a lot of the time it can be hard to read, it can be backward looking, and remember what we said earlier, it's the reaction that counts, not necessarily the news. So when do you buy, when do you sell? Well, I cover systems in the workbook. I'm going to show you some systems on this DVD. The other way to trade is technical analysis. Now, it's very, very important when you talk about technical trading that you don't actually make it that technical. And I'll explain. A lot of the elements of technical trading just don't work. Do you remember what I said earlier about the 80-20 rule? And I said to you that the majority of our money is made from 20% of the time. Well, it's the same with technical trading. The majority of the indicators, they just don't work. Or when I say they don't work, they just don't work enough to give us a balanced view. So I just don't use them. There's an interesting book, and it's called A Random Walk Down Wall Street, and it's by a chap called Burton Mikhail, and he basically went through, and a lot of technical analysis don't like this book, but what he did, he went through and came to the conclusion that technical traders don't meet the market. There are parts of technical trading that I like, and they're the ones that I'm going to show you during this course, but the majority of technical trading I don't follow. Everybody likes a bargain. It's human nature. We all want to buy things cheap. And when I say cheap stocks, I mean cheap currencies, bonds, commodities. The problem is that things that go down tend to carry on going down, and things that go up tend to carry on going up. Okay, so don't think to yourself, oh, I should have bought ICI when it was £5, now it's £6, and then you'll see, it's too late. Well, if the trend is still intact, it's never too late. Day trading, active trading, swing trading, there's numerous names for it. Do you know what? After costs and after the amount of stress and effort, you'll find that the majority of these systems just don't work over the long period of time. Remember, if you just toss a coin and it's heads you buy, tails you sell, well, that's a 50-50 chance of what's going to happen. Many of these indicators, if they can't beat a 50-50 coin toss, then what's the point of using it?